Hello, welcome to the program. Ahead, we'll be taking a look at the strategy of volatility trading, checking in on the latest returns in the hedge fund sector, and also talking about global macro. To guide us through, I'm joined, as we are each week, by Chris Gosselin from Australian Fund Monitors, and our guest fund manager this week is Jerry Pressnell from Headland Global Macro. Gentlemen, thanks very much for coming in. Let's start by taking a look at what's been making news in the sector. Now, last week, ASIC banned a stockbroker over emails he sent to clients. He was found to have been spreading false rumours about the cash management arm of Macquarie and is now out of the game for 18 months. Chris, what did you make of this?
Well, ASIC have been trying for a long time to prove rumourage. My personal view is I think this particular guy was fairly hard done by. He's a stockbroker who's asked to send information out to his clients every afternoon before the close of market. And what he was sending out was what he was hearing in the market. He wasn't. So you don't
think he was trying to profit from it?
Absolutely not. And ASIC said he wasn't profiting from it. He wasn't trying to force the market down, but he was sending out information that turned out to be incorrect.
Yeah.
But if you banned a broker for 18 months every time he told a client some information that was incorrect, you wouldn't have any brokers left. So I think they're looking for a big fish. I think they only really got a very small fish, with all due respect to the individual, on a technicality.
All right. The Financial Review has an interview with Jake Bernstein, a US market veteran and author who's tipping that after a long period of low interest rates, things are about to change and change dramatically. Long-term interest rates have been falling for 298 months, and Bernstein's pointed out that the late 1800s and in the 1930s was the last time we saw that trend. So he reckons over the next 10 to 15 years, we'll see rates go back to all-time highs. Jerry, this is something that I'd like to ask you about. What do you make of this? Do you think he's got it right?
I think there's obviously going to be a lot more bonds coming on issue, and more supply tends to mean higher yields. We did see quantitative easing and a big issuance of bonds in Japan over the last decade when they were going into recession. And even with more supply coming onto the market, long-term yields actually didn't back up at all. They stayed very low over that period of time. So I think possibly there aren't many safe havens around at the moment, and government bonds might still be a good place to have money over the next 3 to 5 years.
What do you think about the likelihood of, over the next 15 years, us seeing interest rates go back to all-time highs? Is that something you see could quite easily happen?
I think if we saw an inflation spike, commodity prices running away because of a much weaker US dollar, central banks could come in and put up interest rates to try and fight inflation, but I think it's very unlikely. I think we're in for quite a long recession. I think interest rates are going to stay low for some time.
OK, well, Jake Bernstein's tip, obviously, if he's right, would have an impact on inflation. There's been plenty of commentary around the Geithner plan in the US that it will, in fact, lead to hyperinflation. Timothy Geithner says it won't happen. He's done a lengthy interview with ABC's This Week programme, and we've got a short clip of that where he's being asked about the plan and comments by Paul Krugman that it's financial hocus-pocus.
This is a piece of a series of initiatives we put in place to help get the financial system doing what it needs to do, which is to provide the credit necessary for recovery. Economies depend on financial systems. They're what's provide the oxygen, the blood that economies need to grow.
But he says it's just not going to work, that these banks are insolvent, and that even if you put more capital in them, eventually you're going to have to take them over.
But I just want to step back for a sec. So this is a piece of a broad framework of initiatives we're undertaking to help restore the strength of the financial system. Part of our plan, a core part of our plan, involves making sure banks have enough capital to provide the lending we're going to need to get recovery back on track. Now, some banks are going to need some large amounts of assistance, and we're going to make sure that that assistance comes with conditions designed to make sure they restructure, provide accountability on boards and management, that these institutions emerge cleaner, stronger going forward.
But one of the things you're hearing from the banks is in part because they don't want all those new restrictions, they may not sell these legacy assets.
That is a risk, and it's very important that people recognize that to get out of this, we need banks to take a chance on businesses, to take risk again. We had a long period where banks were taking too much risk. The challenge for us is that they take too little now. And for us to get through this, we need investors and banks to be willing to take a chance again on providing credit to that business that's got a great idea and needs to grow and expand.
One of the other criticisms is that the investors, especially in the plans to buy up these toxic assets, are not taking all that much of a risk. They're going to put up $6 and they're going to get 93% from the government. We'll share on the upside, yes, but they're protected against huge losses.
George, let's just step back for a sec. The problem we're facing now in our financial system is that banks made a bunch of loans backed by real estate that are now facing losses. And those loans are clogging up the financial system. They're taking up room that could otherwise be used to provide new credits to a business or a family. Now, we have two choices. We can leave that as it is, hope that banks earn their way out of this over time. That would be a mistake. That would leave us with a deeper, longer recession. We're not prepared to adopt that basic strategy.
Well, there's a third choice.
There's another choice. Let me just say, there's another choice a lot of people suggest is the government itself comes in, buys these assets, sets the price of the asset, takes on all the risk in that strategy. Now, that would leave the taxpayer taking on much more risk, much greater risk of loss over time. We don't think that's an appropriate approach. The approach we're adopting, though, is to have private investors come in and put their capital at risk alongside the government.
Timothy Geithner there. Chris, let's look at this, I suppose, from the hedge fund sector or the managed fund sector's point of view. What did you take away from his plan? Does it have legs? Is it going to work?
From a regulatory point of view, there's going to be more regulation. No doubt about that at all. The question is whether we need more regulation here. There's more regulation in Australia than there is in the States. And the risk is that you over-regulate in all that.
Jerry, I know you're not you don't invest in equities as such, but what about sort of more big picture coming out of this plan? How do you think it's going to impact the market?
Well, Tim looks like he's under quite a bit of pressure at the moment, and he's making policy on the fly. I hope that what they do has the effect that they're after, which is to get the economy back on track. I fear that what we've seen over the last 18 months is every time there's an announcement, it's followed up in 3 months' time with another announcement, and they're going to throw another $500 billion at it. So it really depends on how far they're going to go with this quantitative easing, and whether we've seen the end of it or whether there's more bad news to come.
For managers such as yourself, does it provide threats or opportunities or both? I mean, how do you...
This is a fantastic opportunity. You get to privatise the upside and socialise the downside of this trade. So I think there'll be a lot of funds very interested in being involved in it.
That's an interesting way of looking at it. Obviously, it seemed to rally the equity market. Chris, do you have a view? What are you hearing from the people that you're researching on whether this is short-lived?
I think the general view is that until proved otherwise, it's a bear market rally. And the reason for that is we've had so much damage done to the economy that to say, well, we hit a bottom on March the 6th and it's all over now, we're fine, we're back into a bull market. I think that's optimistic at best. Whether it goes down further than the previous low, that's yet to be decided. There's a general view that it might wave around here or trade around here, but quite sharply. Certainly some of the funds we've been speaking to on March have had some good performances. Wingate, who was in here a couple of weeks ago, speaking to them, they're up sort of 6% for March. It's good performance, but it's been a strong rally. It's been a very strong rally.
Jerry, the bond market is, I suppose, can be a good indicator of what the equity market's going to be doing in the future. We had someone in here on Friday, I think it was, and he was basically saying that the debt markets are still telling us that there is a lot more pain to come. This is just a little blip of optimism, of happiness, and then it's all going to sort of go pear-shaped again. Would that be your view?
Yeah, I think back in 2003 we saw the equity market give the lead, where the equity market rallied a good 6 months before interest rates started to go up and bonds sold off. But certainly at the moment you're not seeing corporate spreads come in, you're not seeing credit spreads tighten, so there isn't as much optimism in the bond market as there has been in the equity market over the last 3 weeks.
Okay.